Go live on Facebook. And we are live on Facebook. Hi everybody, welcome to our weekly lesson series. I am Sami Abusad, Director of Education at T3 Live. I hope you are doing well. I hope your week is off to a good start. We're going to be doing what we normally do, which is review last week's lesson and then go on to this week's lesson. But before I do that, if you like this video, please be sure to hit the like button. I'd appreciate it. Also, beneath the video, you'll see some helpful links if you'd like to check them out later. One of the links that I dropped in the description of this video is about a recent webinar. It's a webinar replay of a video that a lot of people have complimented me on, titled How to Write the Perfect Trading Plan. So check it out for sure if you are interested. Without further ado, let's get started by taking a look first at the disclaimer, the standard required disclaimer to let you know that trading is risky and that whatever we discuss today is for educational purposes only. So make sure you agree to that before proceeding. Last week we talked about minor support and resistance. Okay, we said, and I repeat, minor support and resistance is probably the single most important amplifier to understand. Okay, it's the single most important amplifier, where amplifier means things that make the setup even better, that improve the reliability of the setup. Minor support is probably the most important one to understand because it doesn't just teach you about an area where the odds are greatly in your favor if you play long at minor support and short at minor resistance. It also teaches you how to read the charts, how to figure out where support lies or where resistance is on a chart. So let's review that real quick. And I'm not going to read, that takes time. If you want, go over last week's lesson. It was 45 minutes long, so feel free to go over it. We went over this in detail. But I just want to show you this. Minor support is an area that lies at or just above the prior resistance area. It could be a pivot, could be sometimes a base, like so, in a steady uptrend. So again, minor support is what used to be resistance becomes support on a retracement back to it. Does that make sense? So it is that resistance area that was broken through to the upside becomes support on a retracement back to it. And oftentimes stocks don't even come all the way back down to the pivot. They might even stop, like on the way down here, it might even stop right there, above it by a little bit. And I explained that why that happens last week, which is buyers. Anybody remember why? Is anybody in the trading room here with me or on social media remember why sometimes stocks don't even make it to the prior pivot low? Anybody? It is due to right, anxious shorts that start to cover too soon, or they start to cover quickly as the stock gets pretty close to break even. So the reason, the theory or the premise behind minor support is that shorts, people, when the stock starts to come in, a lot of people always go short. They think this is the top. When they short right here, stock drops. They think, okay, great, I was right about it. And then maybe they go on a 15-minute break, and then before they know it, bam, stock pops, and now they're sitting on losing positions. So when the stock starts to come in, they're hoping and praying it comes back down to their break-even point so they can cover it. Sometimes, some people, especially the ones with large losses, they get a little anxious as the stock gets close to their break even and maybe shows some signs of slowing down or starting to to look like it's going to go back up, they immediately cover it. So again, imagine yourself being down 1,000 right here, down 2, down 3, down 4. And now on the way down, you're down 3, you're down 2, you're down 1, you're down 500, 400, 300. You say, what the heck, I'm covering. And it's okay. I'm okay with losing $200-300. I was down 4, 5. So they jump out, or they cover their position before the stock even makes it back down to the prior pivot low, prior pivot high, that is, where they actually shorted it. And that's the reason. And some stocks are just really strong. So buyers, they don't even wait for the stock to come down to the 20 MA or to come back down to the prior pivot. And they just jump in pretty quickly. But this is secondary. You don't need to know this as much as knowing that minor support exists because of shorts that get trapped. They get the chance to redeem themselves. Longs that got out of the stock thinking, they got shaken out, they maybe thought this was the top, they get the chance to get back in it at break even. That group is called the sold out bulls, right? Then you have the professional traders who recognize what's happening, who always buy on a pullback to minor support, to the prior pivot low, like yourself, myself, right? And we add fuel to the fire, the professional traders. And then you have the fourth group, the least important to the four. The fourth group is the group that always looks to buy a strong stock on a pullback, just like you probably know people that always go shopping when things go on discount, on sale, even if they don't need anything. Right? Like, why did you buy this? You don't need. Do you need it? Why you didn't need? Oh, but it was 50% off. So there's some people. These are the bargain hunters. No matter what, they just look to buy a stock or whatever it is on discount when it's on discount. Similarly, a bear stock, when it bounces off the bottom, buyers jump in and buy it thinking it's the bottom, and then when it breaks through, they don't sell, right? They don't want to take a loss, and then they always think it's going to go back up until it doesn't, and then they realize it too late. Luckily, if the stock goes back up, then they get their break even back, their break even point back. They start to sell, which causes the stock to drop. Professionals pile on also, they short it, which adds fuel to the fire. People that were in it short and covered, they get back in it short right here too. They could. And then, as we said, people that always short weak stocks on a retracement or buy strong stocks on a pullback. If you get a buy setup or a sell setup at minor resistance, you get 10 extra points. You get a star, actually 10 of them, 10 extra points. It makes the setup stronger, more reliable. So in this case, we have a buy setup and a narrow range bar, which is another amplifier, at minor support and with a spike in volume. So it's like a 50-point buy setup. Same here, it's a sell setup with a changing the guard, bears changing the guard, narrow range bar, above average volume, at minor resistance. So that's a 60-point sell setup, 60-point buy setup. All right. Real chart now. You get a stock that's in an uptrend, rallies, breaks above the prior pivot high, and where does it pull back to? Right to it or just above it, and then breaks out again or gets bought again. That's resistance, and on a pullback becomes support, and the cycle continues. If the stock was in a downtrend, this is still an uptrending stock, breaks out above resistance right here, pulls back and stops at it, breaks out above resistance. When it starts to pull back, it stops at it too, and it bases. So a base breakout off of minor support, really bullish. A pullback to minor support, really bullish. A breakdown, and then a sell setup right at or right below minor resistance, really bearish, makes the sell setup even better. Actually, to tell you the truth, the best sell setup in general, all things being equal, you can get is the sell setup that forms after a base breakdown, like so. That's the best type of a sell setup you can get. Got it? The best sell setup you can get is the one that forms at minor resistance, but not just at minor resistance. It's the one that forms under a base. Because with a base, is there more resistance or less resistance once you break under it? Is there more resistance or less resistance than, let's say, a pivot, like so? And then you get, oh, I'm out of bounds. Is there more resistance? Oops, my annotation tool is now acting up. Is there more resistance or less resistance when it's a base? More. Why is there more resistance? Because with a base, you have more people getting involved, buying it, right? Does that make sense? Let me redraw that one more time, just restarting my annotation tool, which goes crazy sometimes. So here it is. With a pivot, simple pivot that breaks down, there were some people that bought it here for sure. There were some people, but it didn't spend a lot of time at the bottom, so you didn't get, not a lot of people got the chance to buy it. It just maybe spent 5 minutes there. Okay? With a base, stock drops, bases, and then drops again. It spent, instead of 5 minutes, it might have spent 30 minutes, 40 minutes, an hour going sideways. A lot of people got the chance to get in it if they wanted to, if they thought this was the bottom. Anytime you have a base, people think it's the bottom. Likewise, anytime you have a base, people think it's the top and they start shorting it. I'm talking about novice people, because we know that in general, most bases are continuation or reversal bases. Anybody? Most bases are considered continuation or reversal. What do you guys think? Most bases are, most bases, in other words, in simple terms, in simple English, do most bases continue the trend that preceded them or reverse the trend? Yes, most bases continue the trend. So if you have a base and you get a retracement back to the bottom of the base, oh my God, that is usually an amazing sell setup. An amazing sell setup. Okay. So it's the highest odds setup that I know of, is when you get a pullback to the base. What's the problem with then? Why don't we always wait for a pullback to the bottom, to the top of a base, or a rally and a sell setup to the bottom of a base? The reason why, well, you know it, because they often don't come. They often just go and they never give you a pullback. Like what was it? I already closed out of my platform, or closed out of the charts, but I do have my platform up. Like the MAXR today, right? Let me show you. Reopening my watch list, my platform. MAXR. Did that give us an entry? If you passed on the breakout, did that give us a pullback? No. I guess it did here at the end of the day. No. Most of the time they don't really give you another pullback. Okay. All right. Great. So notice here we have we had a breakdown and then a sell setup. The sell setup was at minor resistance. What's the problem with this minor resistance? What's one good thing, one bad thing about it? One good thing is it happened on a lot of volume. So when the more volume the pivot forms on, the buy setup forms on, the more sellers there will be when it breaks under it. Okay? And the ones that don't get out, they get the chance to get out here at break even on the way back on the retest, which makes this a high quality sell setup. The problem with it is it's pretty old. It's from January. This was in February, a month ago. So resistance with time loses its effectiveness, because a lot of the people that bought it here are long gone, right? They're not around, sitting around, still in the stock. So with time, resistance and support lose their effectiveness for sure. Okay, this was hopefully a thorough enough of a review of last week's lesson that we can just today pick up the thread and continue. And we're going to talk about the 40 to 60% retracement, and show you what to look for when it comes to where to buy stocks, basically. Actually, to tell you the truth, these last 4 amplifiers that we're going to talk about here, they're not the last 4, but The bottom four here that you see on the slide: minor support resistance, retracements, 40 to 60% retracement, moving averages, the 20 period moving average in particular, and the buy or sell zone. These are location amplifiers. They're called location amplifiers, which means they're ways to help you spot the right location on the chart. Okay? Location amplifiers. So today we're going to talk about, as I said, the 40 to 60% retracement. Now, I just want you to understand that a lot of people know about Fibonacci retracements. While there are numerous retracement levels that have gained mass popularity over the years, we have our traders focus primarily on the 50% retracement, which is by far the most prevalent of them all. Because it is dangerous to demand or require that the market be too precise, we focus on the range or the zone that covers the 40-60% area rather than the pinpoint the 50% spot and say this is it. It's either stops right here or not. No, it's a zone, it's an area. This is a location concept and provides the basis for trading combination number 6. But what I wanted to say was, the question that I get is, where did these retracements come from? These levels? Anybody? A lot of people have heard of, most of you have, Fibonacci ratios, Fibonacci retracements, which are areas, the Fibonacci retracement levels are designed to find areas of support and resistance after a move has been made, based on numbers that are converted into ratios, into percentages. And the Fibonacci levels are 23.6%, 38.2%, 61.8%, I think, and then there's one more, 70 something, 78, 70 something like this. Crazy stuff. How did they come up with these? How did Fibonacci, who is a mathematician from 200 years ago, not quite, come up with these levels? He came up with a sequence of numbers. If you add 1 plus, I forget. He came up with a sequence of numbers that if you add the two, if you actually divide one number by the number 2 places to the right and the number 2 places to the 3 places to the right of it, you get certain percent ratios. And one of these ratios, he noticed that it repeats in the universe, in nature, a lot. And he called it the golden ratio. Of course, traders, being superstitious, I don't know, started using that a lot in trading. But we know, things are in trading. Trading is more of an art than a science. Things don't work. The stocks don't stop at the exact percentages. The most prevalent, the most widely followed retracement percentage is the 50% retracement. And again, we don't want to focus on just 50%. We want to focus on the range between 40 to 60%. Now, the big question is there a way to know which one is better? Is it better for a stock to retrace 40%, like so, or 60%? What's better? Yes, 50% is not a Fibonacci ratio. You're right. But 61 is 61.8. Is 40 better? Is 60 better? What is it? 40%, 60%, 50%? What's the best? And Jeff, of course, because he's a very reasonable guy. I know Jeff. He's a very reasonable. He's saying it depends on the chart. Look at the chart. Look where the moving average is at. Look what looks good for that chart, and that should be the ideal percentage. In general, it's between 40 to 60. 60 in general is like at the bottom end of it. 60% is like the most. 40% is at the top, meaning we don't want it to be 40 is like that's the minimum. 60 is the maximum. The truth is, I'll tell you a little bit more about retracements in just a few minutes, but let's cover this first. Okay? So in its most basic form, a bullish retracement is a downward price move in the exact opposite of the direction of the most recent up move. For example, if a stock advances $4, then pulls back by 2, it has experienced a 50% retracement. If the stock were to pull back the entire $4, it is said to have experienced a 100% retracement, which potentially sets up what is called a double bottom. Any rebound from the 40 to 60% retracement zone is considered more potent than from any other percent level when you have an uptrend. Okay? If it's a sideways trend, you want a 100% retracement. If it's a base, you want the stock to be at the bottom of the base. You don't want to be buying it in the middle of the base. Okay? But if it's an uptrend, we want it to stay at the 40-60% retracement. The bearish 40-60% is the same way. If the stock drops from $40 to 36 and goes back up to 38, that's 50%. It's inside of the 40-60% zone. You get 10 extra points. The sell setup actually is more reliable from this zone than from any other zone on any other area on the chart. The beautiful thing is you don't have to take out a ruler and start measuring. It's all visual. You look at the chart and you see that from here, let's say, to here is 100%. From here to here, that's about 40%, 50%. So that's in the right area. From here to here, that's 100%. From here to here, that's 50%, 40%. It's in the 40-60% retracement zone. It gets 10 extra points. That's the most favorable area to buy a stock when it pulls back in that area. But the beautiful thing also is that on many occasions, the 40-60% retracement level will coincide with minor support and the rising 20 MA. If and when this happens, which happens all the time, the potential potency and reliability of the play rises. The same is true in reverse for stocks in a downtrend. Notice the stock was, when it pulled back almost to the rising 20 and to minor support and to the 40-60% retracement level, to the rising 20, to minor support, and to the 40-60% retracement level. So you get all three in one shot. You see what I mean? You get 3 amplifiers in one fell swoop. Does that make sense? Here it is again. Pull back to the rising 20, to minor support, and to the 40-60% retracement. Perfect. Perfect. Now, you might say, is that all I need to know about retracements? No, not really. There's more to it than that. First, I want to share with you this little thing, which is important. If the initial move was an absolute explosion, this initial move off the base, it was just like, let's say, one wide range bar, 1 or 2. You do not want to get 40-60% retracement. It's not a good sign at all. If it's a one big push higher, you only want to get 1/3 retracement. If a stock pops really hard, like so, bases, pops one big bar, it means it is really, really bullish. Because you and I, little guys and gals, can't make a bar like this. It takes a ton of buying, a lot of volume. Hundreds of thousands, millions of dollars, sometimes tens of millions of dollars to generate a bar like this on a liquid stock. So if the stock pulls back after this to 40-60%, guess what? It means there's no follow through to that buying. It means that was just one burst of buying and there's no follow through. But if the stock pops the same way, big pop, and retraces just 1/3 and starts to pop again, that's what you want. If it's an igniting move higher, you only want a 1/3 retracement, 33%. Not more. You do not want it to reach the 20. Again, I repeat, you do not want it to reach the 20 MA. You want it to stay well above it. If it's just an explosion like so. If it was multiple bars up, slowly but surely, okay, you do want it to come back down to minor support and the 40-60% retracement level. Got it? But if it's just one bar, you want 1/3 retracement. If we were to draw the whole, from here to here and then back down, that's the 100%. So we said in general, by the way, you don't want a rounding top like this. I was just drawing it, but you don't want to, what you want is a V pivot. A V pivot has less resistance than a rounding top. But let's say, you know, here's the initial move from the bottom to the top. So this is 0% or to 100, right? I can't, you know, draw here quickly enough, but anyways, that's 100, whatever. If the stock were to, my annotation tool just got stuck a little bit here. Let me see. I'm gonna restart it, reopen it. It doesn't like me using too much ink, I think. If a stock were to rally, just gonna make it smaller. From if a stock were to retrace to here, that would be the 1/3 retracement, and we said it's good only under one condition, which is if the initial move was one wide range bar, and you get a 1/3 retracement. So that's what we call a 33% retracement, which is again only valid under one condition. 40 to 60 is the perfect area. That's more than 40. That's, let's say that's 50%. We want the 40 to 60 is the valid area to look for most stocks to pause or to turn back up. Now, if a stock drops below 60%, what does that tell you about the stock? So again, this is 60%. That's 40% at the top. What does that tell us about the stock if it retraces more than 60%? It tells us that the stock, the bulls are not so strong that they're holding on to the majority of the gain, half the gain. They need to hold on to at least half the gains. It means the stock is too weak. Not only that, think about the people that bought it up here, or over here, or over here. Now they're sitting on big losing positions. Oftentimes, I get in a stock and I let it go against me by a little bit, thinking that it's going to go back up. But what if it doesn't? What if it continues lower? Does that make sense? Then at 60%, 70%, 80%, I am really dying to get out of it. I start telling myself, oh my God, this is going to kill me. I mean, I was wrong on it. So if it starts to bounce from 60, 70, 80%, it almost always will fail. That buy setup will almost always fail. We don't want buy setups that fail because then we lose money. So redrawing this one more time. What if it goes back down to 100%? Is that a good area to buy? Right there at the bottom at 100%. What do you guys think? Isn't that what is known as a double bottom? And the answer is yes, it is. But the problem, what's the problem with that? In most cases, the problem is you retrace 100%. That's a sign of weakness. Everybody that bought it and held on to it is now underwater, except for the ones that bought it at the absolute bottom, right here. Otherwise, every single person is underwater. So at 100%, what normally happens is you get either a pause or maybe sometimes the stock bounces a bit, but then it fails. Why? Why does it pause? Why does it, anybody? Why do we get that small bounce and then the rollover, as Jeff is saying here in the room? Reason is because that's support. A lot of people that bought it got rewarded. They look to repeat their actions. They look to buy it again. And then, so it may cause the stock to bounce a little bit. And shorts, they don't short anymore. They stop shorting. The sellers stop exiting. But usually, if it retraces 100%, it goes below 100%. Okay? And after it breaks 100%, not by a lot, by a little bit, it gets a bounce, which takes us back to 1/3 and then continues lower. Why is that? Why is it that we routinely see stocks break under the lows and then they bounce? They reach what we call the 110% retracement level. They bounce a good amount, 1/3, and then they fail again. Anybody know why that happens? Does anybody know why that happens? I'll go ahead and explain it. If you were in the stock, still holding on to your long position, let's say, you bought it here at the top, okay? I can't draw anymore because I'm not even kidding. When I draw too much, my annotation tool gets stuck. It thinks I'm using too much ink. But just try to follow along just by, look at the cursor. Let's say you bought it up here or bought it over here. And now you're down 4,000. You're down 1,000, 2,000, 4, 5, 6, 7, 8. Why would you still be in it? You see that it's going against you, keeps going against you. Why would you still hold it? Some people would still hold it. Anybody know? Of course you do. Some of you know. And the reason is because they're hoping for the prior support to hold. Does that make sense? Once it finally breaks, they sell, which generates that last burst of selling. But once the last batch of sellers are out, you get the little bounce. You get the dead cat bounce, basically. But this is a weak stock. Is now in a downtrend with lower highs and lower lows. And that's why it continues lower later on. Does that make sense? This is called the 110% retracement level, which oftentimes is a buy opportunity right here. At the bottom is a buy opportunity. Okay? But you got to be nimble, because this is a weak stock that is going to continue lower, so you would only be looking for a 1/3 retracement, 1/3 of that sell-off. From here, from the top to the bottom, that's 100%. From here to here is about 1/3. Got it? So when it comes to retracements, we have several levels that we look at. I said if the initial move was an igniting wide range bar, then we look for the 1/3 retracement. Otherwise, if it's just a normal rally, then we look for the 40 to 60% retracement, with the ideal percentage being wherever the 20 MA is at, and the minor support. It could be 40, sometimes it's at 40, sometimes it's at 50, sometimes even at 60. Below 60, and then you have a too deep of a pullback. If it's too deep of a pullback, the stock would have to really prove itself before buying it. Meaning, let's say we do get a 70% pullback, then I wouldn't buy it. But let's say it actually does pop nicely, like so, and then it goes sideways. Now you can play it on a breakout. That's the bleed pattern, right? Which is what we did on race today, but as a short on the 15-minute chart. This one, right? It dropped, went sideways, played it short. Rallied, goes sideways, you can play it long. So you'd need a secondary sign of strength. If you get a deep pullback, don't do the first buy setup. Maybe wait for it to double bottom and you can do the W pattern over the neckline, or you can do the base breakout, depending on how it sets up. Does that make sense? But normally it's not playable after if it drops more than 60%. Now, if it drops to 100%, I do not recommend buying double bottoms. There are some exceptions as to when you can do a double bottom. It's probably another topic for another day. Actually, I know it is a topic for another day because we will cover double bottoms in future lessons. Okay? But you can look to buy the 110% retracement if you have multiple time frame alignment. As we said, if the stock drops below the prior low, oftentimes you get a small bounce back up and then it continues lower. So you can buy the 110% retracement or scalp it a little bit. But that's basically, in a nutshell, all you need to know about retracements. Trust me on this, you don't need to use Fibonacci. I know some platforms, a lot of platforms have the Fibonacci tool, and you can drag the stock from the top to the bottom and it gives you all the different ratios. You don't need that stuff. You just need to be objective, look at the chart, listen to the message of the market, let it tell you where you should buy it, not based on these fake lines on the chart. Okay? What buy setup are you likely to get there? Climo? Yes, a mini climactic buy setup. That's correct. And a little bit of an acceleration. It's like this. I'll show you. But this is when it took out the prior high. Remember the ITSI today? Took out the prior high, and then you get that climactic move, and then it tops out. It didn't top out at the prior high. Does that make sense? It didn't actually top out at the prior high. It took it out and then it topped out. Right? So it's exactly the same. Here's the prior high. doesn't top at it. Usually it takes it out and then it tops out. But we ran out of time. Otherwise, you could play, you know, we could have looked to play that little bit of retracement back up. All right. Very good. If you enjoyed today's lesson, I invite you to join me in the Strategic Day Trader room. And if you're brand new to the room, you can get in for $49 for the whole month. For 30 days for $49, which gives you plenty of time to try it out and see if it's something that you like or not. Not going to be here to brag about this being the best or biggest or baddest room in the whole world. I just want you to give it a try and see for yourself. All right? If you have any questions, reach out to customer service. But if you're ready to try it out, link is in the description. As you can see, I don't talk about mumbo jumbo stuff that's just pulling it out of thin air, that you'd have to really believe me to you know. No, you don't even have to believe me. Follow the charts, follow the money. I try to be as objective as possible and listen to the message of the chart, of the market, of the stock that I'm trading. And I don't just do that because it's good for me. I do that because that's the only way to make money, is by being objective. If I'm all over the place and inserting my own opinions about things, you'd never make it as a trader. Okay? You'd never make it. So I try to stick to the charts, be objective, and let the charts make me the money, basically. Let my ability to read the charts and manage the trade make me the money. But otherwise, I basically just, my goal is to be 100% objective. It's not possible because we all have certain biases and programming, and we see things differently, right? But I try to be as objective as possible when it comes to chart reading. I hope you enjoyed today's lesson. Again, check out the links in the description. If you have any questions, reach out to our customer service team. Thank you so much, and have a wonderful evening. Take care, everybody.